Rob, let's just start by why don't you tell us why John Hancock would invest in the infrastructure asset class?
Well, I think they asked me onto this panel as the voice of the plain vanilla institutional investor that there's a lot of talk about institutional money and what it's looking for, and I think I'm sitting here because we are institutional money, and I don't want to exaggerate kind of where we are in the process of investing in the developing markets. Quite candidly, the earlier statement that capital is cowardly is quite true. Some of us are more cowardly than others. And I think that, when you think about institutional money, particularly long institutional money, like an insurance company or pension fund, we're looking for long, relatively safe assets. And so my particular portfolio is the infrastructure asset equity portfolio. It's a little over $3 billion. And it consists primarily of what you would think of when you think of core hard assets, such as power generation, transmission grids, airports, ports, roads, traditional hard assets. And like most institutional investors in the asset class, we're really looking for a long stream of predictable cash flows, about as boring as you can get. And to an infrastructure investor, one of the underpinnings of long, boring streams of cash flows is predictability. And predictability comes in many flavors. It's like Baskin-Robbins. You have 52 flavors of predictability. And for us, we look at things such as legal regime predictability. We look at things such as the offtake. When you own a power plant, who is buying the power from you? Is it a predictable, reliable credit on the other side of it? And so I think when we look at infrastructure, it typically provides most, if not all, the characteristics of predictability that ultimately translates into stable cash flows. And as an insurance company, we're really not the profit center. The profit center are the exciting guys that go out and sell policies and do that fun work. We're really the backbone to make sure ultimately the policyholder gets paid. And so from a long-term institutional raising of capital perspective, I think my sense is that Africa generally, and in certain countries in particular, is moving in the right direction. But I think ultimately it's going to be a period of transition. Our exposure to Africa is really through, as you'd expect, through large corporate conglomerates that have substantial operations in Africa. We're a significant lender to many of those corporations. Ultimately, as those corporations move operations and look to do project financings on the continent, those are the type of financings that we would look at along with probably political risk insurance in place and trying to mitigate some of those unknowns that are inherent in the continent. And then as you have one or two projects that have been developed by these conglomerates that are creditworthy in their own respect, then you can start looking for more direct investment directly into projects backed by local sponsors. And again, it's in my view, in an institutional view, or at least our institution's view, it is a process, but it's a process that's certainly underway. And you can kind of see it through to a point in time where you can see institutional investors buying in and doing more direct investments alongside local sponsors rather than through large international conglomerates.
Doing business in Africa. You can't afford to be without Africa Investor.